Hi, thanks for tuning in. I want to talk about investing and obviously successfully investing. And if we're thinking about retirement, we've probably got to do some successful investing. So the current stock market is, where are we now? June 2022. We've had a bit of volatility this year. We've had some reasonable declines in the global markets, and it can start to spook you. So I want to just try and give a bit of context to all of this and put give you a bit of data. Now, hopefully this won't be too dry because it is about some numbers. I'm fortunate enough to have quite a lot of statistics in front of me, and I look at the evidence to back up, hopefully, my arguments. So let's have a look at what's going on and see. Hopefully this may help you and educate you into putting our current market volatility into context. So the first thing I want to show you is something called the MSCI World Index. If you can imagine investing in all the companies across the world, and you were agnostic about which company you were in, you weren't choosing British American Tobacco over Tesla or Microsoft over Apple, you just said, I'll have a bit of everybody. So you're not actually doing anything particularly clever, you're buying an index fund. Now, they actually weren't available, I don't think, in 1970. I was just born in 1970, so I don't know, I'm afraid. I wasn't around to choose investment funds at that moment in time. But if you could have bought just an index fund, nothing cleverer than that, and you put your pound in, where would you have ended up, and what would your investment experience been like? Well, the first thing I can show you here, there's the growth of a pound. £1 would have grown into £252 over that period, which sounds fantastic. Well, what does that represent as a percentage? Because this is the type of thing we're used to. So in 1970, if I just make that a little bit bigger so you can see it, in 1970, the stock market fell by 2%. So nothing particularly significant. It's gone down a little bit. I think most people can handle a 2% fall. And in 1971, it kindly went up by 12%, so a nice return. And in 1972, it went up by 34%. And of course, when people see these types of returns, lots of money gets flown into the market, pushed into the market, because people are starting to be confident. But sadly, in 1973, it fell by 13%. And 74, it fell by a further 25%. And this is, of course, the time that people start to get out. And between 1970 and 1974, you've actually lost money. You've got a minus 0.9%. So this is where the short-term context can really do you in. So let's actually look over the longer term. So 1970. So I'm 52 now, and this is these figures are to December last year, so it hasn't got the most recent volatility into it. But you can see here the annualized return over that whole period of time has been 11.2%. So all you had to do is put your pound in and wait 52 years, and you'd have had an annualized return of 11.2%. Now, most investors actually haven't received that, sadly, because what happens is that they get spooked. And, they get spooked by these early crashes. I can tell you in 1987, I'd been in the world of finance in my first job, and I remember Black Friday, and it was a 30% decline. And in 1987, over the year, there was an 8% decline in the stock market. And you can see that people have been probably a little bit over exuberant the previous year, when in 1986 it had grown by 39.8%. In 1985 it had grown by 14%. In 84 it had been growing 32%. In 83, 37%. So significant growth. Then we have a bit of a tumble. Then in the 1990s, we have a bit of quite a market fall of 1990. Global markets fell by 30%. So, and then if I go to the dot-com bubble, for those of you who may be too young, but we had, lots of money was flowing into new up-and-coming dot-com companies, and sadly, quite a few went to the wall, and we had a whole period of distress. You see all these red numbers where the market fell. So you can see how the ups and downs of the market can be quite emotional, and when you're seeing your portfolios fluctuate by significant values, it can be quite frightening. But so we come back to that long-term return. All I had to do was put my pound in and get 11% annualized return by the time I get to 52. Even including all those market declines, that's the actual net return that I would have received. But we need to give a bit more of a context on this, of course, as well, because we also need to understand, well, what's inflation done over that period of time? So let's have a look at that. The next lot of data I'm going to share with you is the UK inflation figures. So this spans a bit longer time frame. So it actually goes back to 1948. And I think just for context, it would be quite interesting to see a few of the numbers from here. So the long-term return, the inflation rate over that period between 1948 and the end of 2021. So I appreciate it hasn't got this current period of inflation in, but the long-term inflation figure in the UK over that huge period since 1948, 5.2%. So there's some context around that. And then let's talk about higher inflation figures. If we go to the 70s, because I know that period is quite high, 70s, 7.8%, 71, 9%, 73, 10.6, 74, 19.2, 75, 24.8. So we, it's very easy because of the time horizon that we've looked at for the last 10, 20, 30 years inflation has been anything like that, those numbers, to forget that we've had hyperinflation figures in the interim. So, but of course, let's go back to the key number here. So we had an inflation of 5.2%. So if you had a pound in 1948, and in fact, sorry, we were talking about 1970, the year of my birth, because that's the context we want to get in. So if I get to the column of 1970 and I go all the way down to 2021, you can see that the inflation figure has been 5.7% annual. So of course, what I'm hoping for my investments to do is to beat inflation. So let's just have a flip back and to understand. So 5.7% is what we've got. So we come back to the kind of anyone can do it. Anyone can buy an index fund that tracks the world markets. You can do that pretty cheaply. These numbers are over 1970 to 2021. So 5.7% was our inflation figure. And if I go back to the return that we received by the anybody portfolio, 11.2% annual return. So the return that you've received over and above the inflation, 11.2 against 5.7. Now, I appreciate there's going to be some costs of trading, cost of buying into the index. The fund manager is going to make a small charge for doing it. And a cost of buying products such as pensions, etc., or an ISA or what have you. But there are some tax advantage products, of course, and with pensions, etc., there's even tax relief. You're getting money added by the HMRC to enhance your investment, so you're getting even an improvement on the amount that you're actually putting in, or the net amount that you're putting in. So your annualized return, look at that and ignore the kind of market noise. Think about if I was planting a tree. When's the best time to plant it? Well, 50 years ago. But if I was planting, and then the next best time to plant a tree, well, today. And of course, when you've planted a tree, and the analogy of getting invested, planting a tree, what you don't do is you don't pull it up every 2 seconds to see how it's getting on. You just get it in, put it in, and what you might do, of course, is you might plant more than one tree, and you might plant a number of different species of trees so that they, if there's a blight on horse chestnuts, then your ash or your beech don't get struck by that as well. So you create a diversified portfolio. I'll cover more of that on future videos, and actually maybe even how you can enhance some of these returns by looking at smaller companies and value companies over the longer period of time. But just as a starter point to get some context around the current market volatility, we've always had it. I'm sure we'll always had it. It's why you get a higher expected return from investing in equities than you do in cash. But the ravages of inflation are key, and to look at the long-term historical numbers, but also look at the long-term historical returns that you received just from a global index. And all you had to do was stay in your seat and stay invested and not get emotional or over exuberant when the market goes up and not get too despondent when the market goes down. Just realize that this is part of being a successful equity investor, a successful investor who invests in companies of the world whose purpose is to make profit and to pay out dividends to you, the investor. I hope that's helpful. I'm Justin King. I'm a certified financial planner, and my aim is to help people live successful lives. That often involves understanding your money. I hope you've liked this video. If you have, please press the like button and of course subscribe so we can let you know when we put out new video content. For now, I'm Justin King, helping you live your best life.